Hey everyone, welcome back to Chip Stock Investor. Today we're going to talk about a few semiconductor adjacent companies. We have Air Products versus Linde, and then Albemarle versus SQM. Then we have a bonus company that we're going to talk about. Nick had a wonderful interview recently with one of the management team of On Semiconductor, so stay tuned till the end.
I got a chance to talk with On Semi CFO Thad Trent. I was excited to be able to finally meet him. I've been an On Semi investor at various times over the last 2 decades, but I was very happy with Mr. Trent and the CEO, Hussein El-Khoury, when they took over at Cypress Semiconductor a number of years ago and orchestrated the eventual acquisition of the company by Infineon. So we are building a position again in On Semi, this time for the long haul. So I've learned some interesting things about On Semi. Stay tuned for that. Before continuing, let me remind you to hit the like button and subscribe to the channel if this video is helpful as you do your own investment research and increase your knowledge of business and technology. We really appreciate the support, as subscribing to the channel helps us continue putting out content like this.
Okay, to kick off our first segment here, we have Air Products versus Linde. And these two companies you may not think of as semiconductor companies, but we're going to look at our industry flow chart here, and Nick can tell us exactly where these two companies fit in on this chart.
Yeah, both companies, like you said, Kasey, not semiconductor businesses, not tech businesses. These are industrialists through and through, which I like to think, industrialists, before we started using the phrase information technology constantly on a daily basis, industrialists were like the technology businesses of the 19th and 20th century. But they sit at this very critical juncture here, basically at the beginning of the chip manufacturing process. Before chips can be designed and eventually fabricated, you need to build out important infrastructure to support the fab itself. So base materials and gases, Air Products and Linde provide absolutely critical material that chip fabs need to make chips. And it's similar to this is Albemarle and SQM, which we'll talk about in the next segment. They also fall under the same category here. So a very important semiconductor adjacent business. Basically, you can think of all of the work done the last 2 centuries. Basically, the semiconductor manufacturing market sits atop all of those accomplishments. Chip making wouldn't be possible without these businesses.
Let's jump right into our first segment then. Air Products versus Linde. Let's just look over the financials for Air Products here. It just reported actually yesterday. So revenue was $3.2 billion, which was a 9% year-over-year increase. And then they have a negative free cash flow, $1.4 billion for the 6 months ending in March. But we'll talk a little bit more about that here in a bit. They did adjust their guidance for earnings per share to $11.30 to $11.50, which is up 10 to 12% year over year on an adjusted basis. And then they expect the capital expenditures to be $5 billion to $5.5 billion in the coming year.
Yeah, this was by and large an as expected quarter for Air Products, right? I think one thing that we'll note on this one and Linde is these are never going to be super exciting hypergrowth businesses, as expected for an industrialist. But it's hard to argue against average earnings growth in the low to mid-teens percentage year in and year out. And that is really the top feature, I think, of both of these businesses. Air Products has been delivering adjusted earnings per share growth at about a 12 to 13% rate over the previous decade. And that's their outlook for the next few years as well, maybe closer to a mid-teens percentage growth rate. And a lot of it has to do with this resurging interest in investing in manufacturing, including chip manufacturing. So, Kasey, we pulled this slide up here from their presentation. They actually provide this every quarter with some very minor updates on their upcoming major projects. And this is not a precise chart to give you an idea of where the company gets its revenue, but it does give you an idea of where they are generating that consistent growth. And you'll see throughout here, a lot of this is green hydrogen projects. So if you're thinking about renewable energy, also gasification projects, it could be natural gas in North America and in other places around the world. One interesting one that has been popping up on this chart for a while now is the semiconductor project in Kaohsiung, Taiwan, for about 900 million. This is actually an expansion project for Taiwan semiconductor manufacturing. They have been delaying this project because of economic headwinds, but you get the idea here. Be it renewable energy, carbon capture, semiconductor manufacturing projects, Air Products is there. And so as manufacturing investments ramp up, we think this company will be a slower and steady winner for a long time going forward.
Okay, let's take a look at their dividend history here. They have a really wonderful chart here that shows just how much focus they put on giving back to the shareholders. Can you explain a little bit about what's been in the past and what they expect in the future?
Right. Yeah, that's the real reason I think you would want to invest in a company like Air Products is the stable growth in the dividend over time. Again, very similar to the adjusted earnings per share growth. This time about 10% over the last decade. I think that's notable too because Air Products, like you mentioned, Kasey, generating negative free cash flow at the moment. That's because of the capital expenditures expected to be at least $5 billion this year. They are investing a ton of money, but that will eventually pay off in the years that come. As these projects finish up, they'll have a big rebound in free cash flow, and we think the dividend that will flow through to the dividend in the form of steady annual dividend increases. And they do repurchase some stock as well over time. So we'll show you the chart for this on when we talk about Linde here in a moment. But you'll notice for Air Products over the last 5 years, it's been roughly flat. Their shares outstanding have been roughly flat. A lot of their attention has been on the dividend, but we think going forward, share buybacks will feature more prominently for this company as well. So overall, if you're looking for a slow and steady dividend stock over time, we think Air Products could be a top one that you give some attention to.
Currently, as of this recording, the stock is around $280 per share. Do you think that is a fair value for this stock?
It's approaching fair value. So we've been watching Air Products now for a number of quarters as it's become increasingly apparent that manufacturing investment is ramping up. We think Air Products and Linde will benefit a great deal, but these stocks are not cheap, especially for something that is not ever going to be super high growth. As we record this, Kasey, I think Air Products trades for about 27 times earnings. Yeah, about 25 times expected adjusted earnings for the current fiscal year. So at 25 times expected adjusted earnings, I think this is slightly on the side of overpriced, which is why we have not purchased this one, nor have we purchased Linde for a similar reason. I really think a fair value on this would be closer to about the $250 to $270 per share range. That would be closer to fair value. And that's assuming $11.40 at the midpoint adjusted earnings for this year. Adjusted earnings growing at about a 13 to 15% rate on average for the next 5 years, and then 5% adjusted earnings growth after that. So I'm not comfortable with this one at the moment. But again, if you're looking for the next decade ahead and you just want a stable dividend stock that you can forget about, I think now is as good a time as ever to make a purchase, because I'm starting to think that companies like Linde and Air Products are going to be two of those stocks that just carry a high premium indefinitely going forward because of all this interest in manufacturing investment right now.
Let's move on to Linde, a competitor of Air Products. Let's run through some of the numbers for Linde's most recent quarter. They had a revenue breakdown of $8.2 billion, which was flat year over year. They had $1.1 billion in free cash flow, which is a little bit different than what we said with Air Products. And for the second quarter of 2023, they expect adjusted diluted earnings per share in the range of $3.40 to $3.50, which is up 10% to 13% versus the prior year quarter. And the full year capital expenditures are expected to be in the range of $3.5 billion to $4 billion.
So a couple of things to note here on Linde. I think some of the flat revenue growth year over year is due to them closing down their Russia business roughly a year ago. So I think this company returns to growth, revenue growth going forward, as they no longer have to lap having the Russia business going forward. Another interesting thing here, you'll notice Linde is roughly double the size of Air Products. Linde is a giant in this industry. It's the product of a merger between Linde and Praxair back in 2018, about 5 years ago. In spite of the far larger size at Linde, their CapEx, their spending on equipment and on property, is over $1 billion less than Air Products. So Linde is a bit further along in its investment cycle, and they're starting to get some nice earnings per share and free cash flow growth from past years' spending. Now, what comes with that, I think, is a higher multiple, a higher valuation on the stock, which we'll get to here in a moment. But I think that's the big takeaway here. Linde, a giant in the industry, and so thus you're going to get some positive free cash flow numbers versus Air Products, which is investing very heavily in CapEx this year, and so thus negative free cash flow. That's going to skew your numbers a little bit if you're trying to compare these two companies side by side.
You can see from this chart here that Linde provided on their global end market trends. They have a lot of different segments here. They dabble in many different markets. You can see from the chart here in the year-over-year sales growth portion, electronics and manufacturing are by far and away the biggest growth drivers here, 15% each on these. So this is why we are focusing on companies like Air Products and Linde, because of these growth opportunities in these fields, which fuel the semiconductor industry.
Another thing that is interesting about this too, Kasey, specifically on electronics, though it's only 9% of sales, it continues to grow at a double-digit pace for Linde. So in 5 to 10 years' time, I actually think electronics could be a much larger portion of Linde's total revenue breakdown. But what's interesting to me about this is the year-over-year sales growth rate up 15%. This is in the midst of a pretty nasty downturn for the chip manufacturing and electronics device manufacturing markets. So Linde still getting increasing revenue from these customers despite a downturn. This could be a really fantastic way to play gradual growth from electronics, specifically electronics and chip manufacturing going forward, if you're looking for something that's maybe a little less cyclical than a specific semiconductor stock.
In Air Products, we talked about how they have focused on their dividends and share buybacks. What about Linde? What does Linde do in this space?
This looks even better. So again, a chart from our friends at Main Street Data, You can see the shares outstanding. About 5 years ago, shortly after the merger with Praxair, over 540 million shares outstanding. That's been reduced to 490 million shares. So a roughly 10% reduction in shares outstanding over the last 5 years. That is fantastic. And along the way, even in spite of a horrific period in 2020, early on in the pandemic, you can see a stable and growing dividend along the way. So this is not the highest paying dividend stock. It's only 1.4% dividend yield at the moment versus Air Products currently yielding 2.5%. But Linde more than makes up the difference here, as you can see from these charts, with the ongoing buybacks over time. So again, a fantastic growth and income stock if you're looking for something to just buy and hold for the long term.
This stock is sitting around $364 a share as of this recording. Is that a fair value?
This is another one we have not bought yet because for a slow and steady growth business, the current valuation of about 40 times trailing 12-month earnings, 34, 35 trailing 12-month free cash flow it's just a little rich for our taste, right? Especially when you can get a similar valuation for a much faster growing tech stock. That being said, much like Air Products carrying a premium for the long term, we also are starting to think Linde is probably just going to have an elevated valuation going forward, given this steady investment into tech and manufacturing, the electrification of the power grid, renewable energy getting a ton of attention. We think that legislation like the CHIPS Act, like the Inflation Reduction Act, are just an added tailwind for this company, for Linde. So I think it's above fair value right now. Okay, so based on their outlook for adjusted earnings at the midpoint of about $13.65, if we assume roughly low to mid-teens earnings growth over the next few years, and then maybe 5% earnings growth after that, beyond 5 years, I think this is basically fairly valued at about $360 per share right now. So the stock is roughly valued, but again, I would only nibble on this stock if you're looking for a slow and steady dividend and growth investment and you plan on holding for at least 5 years. This one is a little bit rich for my taste given what it does, but maybe a high valuation that sticks around for a long time, given the new secular growth trends in the economy right now.
So since this is a versus segment, you have to pick one, Air Products or Linde. If you had to pick one, which would it be?
In this era of fractional share investing that you can get from most brokers, I hate this question. If you're unsure, just buy a little bit of both and then set it and forget it. But since you've tried to pin me down here, if I had to choose just one to invest in today, I lean a little bit towards Air Products for two reasons. I think on an adjusted earnings basis, Air Products is a bit cheaper presently based on trailing 12 months results and expected forward adjusted earnings. So I like that, a little bit of a discount to Linde. Also, like we talked about with the CapEx, Air Products investing at least $5 billion this year in new projects. That's pushed their free cash flow into negative territory. That's a present risk that I think the market is factoring for at the moment. But once Air Products cadence of investments kind of cools off, some of these projects they're investing in begin production and the company grows as a result, I think Air Products stock price could make a jump in the next year or two Plus, you do get the higher dividend yield along the way. So if I had to pick just one, I do lean a little bit towards Air Products at this particular juncture.
Okay, let's move on to our second segment here, Albemarle versus SQM. These two companies are top lithium mining companies. First, why don't we talk about Albemarle's most recent earnings update? So their net sales were $2.5 billion, up 129% year over year, and their adjusted diluted earnings per share, $10.32, up a whopping 334%. So, Nick, what is going on here?
Albemarle has been around a long time, but they made a really hard pivot starting about 5 years ago to go not all in on lithium because they also have the bromine business. They also have the specialties business that plays in fuels, basically catalysts for refining fuels. But by and large, it's the lithium business that moves the segment. It takes years, though, to get a mining project up and running. So this time last year, production was still working off of a very small base. This year, they're in full production. So huge increases in revenue. And of course, as you ramp up production for any, mining or manufacturing or industrial business whatsoever, you always get the higher profitability as you scale up. So thus the even bigger jump in earnings per share. The company was barely profitable a year ago. Now they're very, very solidly in the black.
So, as Nick mentioned, Albemarle is a very large company in the lithium mining space. You can see from the next two slides here just how big of a global footprint this company has. You can see that many of their mining operations are in Australia, Western Australia, but as well in Chile, in the United States. It has a very large footprint here. So you'll see a key difference here with when we cover SQM as far as where they're geographically located versus Albemarle. But as you can see, Albemarle is all over the world. Let's talk a little bit about lithium pricing and how that's going to affect Albemarle's guidance in the coming years, because lithium pricing is coming off of its all-time high here. We'll show a chart just how much it's taken a tumble in the last year. So, Nick, how is that going to affect Albemarle and SQM in the future?
Yeah, you could look at the chart over the last year and think, wow, this is really ugly. But actually, I think this is a very healthy situation because in 2022, the lithium market was undersupplied. There was too much demand, not enough supply. Now we've kind of flipped and we've gone from undersupply to a short period of time where we're now oversupplied. So in particular, lithium carbonate prices have tanked like some 70% from their peak just in November 2022. Interestingly, though, lithium prices based on spodumene, that's like the hard rock lithium versus lithium carbonate, which is kind of derived from like salt flats. That's like what they're getting out of Chile. Also, what Albemarle gets out of its operations in the Carolinas and the operation in Nevada. The spodumene prices have continued to stay high. So the company did reduce its guidance for the year. The revenue outlook was reduced about 13% from what they said a few months ago. Their adjusted earnings per share reduced as much as 20% from 3 months ago as a result of lithium prices falling. We could look at this and say this is worse than expected because historically, Albemarle has locked in long-term supply agreements with its customers based on a fixed price. And they did that to try to cut out some of the peaks and valleys in lithium. But I think what has happened last year, some of these customers, when their contracts came up for renewal or they renegotiated their contracts, they said, we do not want to renew right now. We want to take the spot price. And so what that means is as current market prices, especially for lithium carbonate, have fallen, Albemarle is now selling to those customers at a reduced price compared to a year ago. The good news is, though, you pulled this slide, Kasey, on their outlook for 2023. They're still expecting lots of sales growth this year, roughly 40 to 45% at the midpoint. And their adjusted earnings are still expected to, more than likely grow. Maybe not much, maybe 5% to 10% growth at the midpoint of current guidance. And again, that's just because lithium prices are down from where they were in 2022. But the company is still, as you can see, highly profitable. It's not like reduced lithium prices means this is no longer a lucrative market. On the contrary, Albemarle, now an established leader in supplying lithium, and they're rolling in the cash at the moment.
And just one key point here, their guidance is reflected in the current market prices for lithium. They're not predicting the price of lithium to go up. They're just holding it flat where it's been and setting this guidance. So, of course, the reason that lithium is such a huge deal is, of course, the automotive industry. And lithium is in all kinds of products that we use, in all kinds of batteries for our smartphones, our computers, and of course, the electric vehicles that are pushing the growth in some of the semiconductor companies that we're covering. You can see the global EV demand outlook in this chart. It's just exponential growth continuing. So, Nick, what do you think about this company's ability to continue supplying lithium to the EV market and the semiconductor industry, which fuels that market?
Kasey, just to illustrate your point here, lithium ion batteries are not new, right? We all have one of these riding around in our pockets. But if you think about the demand for lithium going forward, you have a battery that is roughly the size of a smartphone right now. That's the current market for lithium primarily. And now we're talking about all of these batteries needed that stretch the entire length of a car. Basically, if you get an EV, you're riding on top of a battery. That is exponentially more lithium in a brand new application. And then if you expand this to energy storage, basically big giant battery packs plugged into the energy grid to help manage peak energy demand and then off-peak demand, basically storing energy in a battery during off-peak so that it can be used during peak demand periods. Those batteries are even bigger than what's in an EV. In fact, some companies are talking about taking old EV batteries and stacking a bunch of them together to create an energy grid battery at the end of the life of an electric vehicle. So again, exponential growth in lithium. This is why we really started to home in on Albemarle in 2021 specifically, when we were looking at, how do we want to invest in lithium? Then eventually we ended up buying Albemarle more as like a hedge against inflation in 2022. But now we just kind of like the stock for the next decade and beyond because they're so well positioned to supply that growth over the next decade. They have a global operations footprint, not just in Chile, which we're going to talk about more in depth here in a moment, but in North America, Western Australia, which is actually far and away the largest region, the largest region of the world that produces far and away the most lithium. They have 2 joint ventures there in Western Australia. That's where the spodumene is coming from, which can tend to be a higher grade lithium. In addition to that, Albemarle also has the resources to invest in these conversion facilities, basically the refining of the lithium itself. So they're actually building a nice kind of end-to-end production company. They mine it. They can also go out and purchase raw lithium from its competitors and help supply their conversion plants that they're building, and then supply an even higher grade lithium to like an EV maker or a battery maker or whatever. And then they're also developing that research facility in the Carolinas I think they're actually going to apply for some CHIPS Act funding for that to help fuel research into new lithium uses, new lithium material ingredients. Basically, if you think about this as like an ingredients list for a cooking recipe, they're going to start developing new recipes. We like this company. We think they're very well positioned, and we think they'll come out on top, not just as a top lithium producer, but by the time it's all said and done, we think Albemarle will be just a top mining operation that's listed alongside the giants, the current giants of the industry, like Rio Tinto, like BHP Group, like Vale. We think Albemarle could be that type of giant in the mining industry.
Just as a quick side point, I looked up how much lithium actually goes into batteries. And in a cell phone battery, it's like 1 or 2 grams of lithium that actually goes into a battery. But in a electric vehicle battery, it's up to like 8 kilograms. So it's a big difference, right? This is why so much lithium needs to be provided for all of these vehicles. Let's talk a little bit about what's going on in Chile. We'll discuss this a little bit more about when we cover SQM, but recently the Chilean government has made a few tweaks in lithium production. The CEO of Albemarle was asked about this, how this is going to affect the company, and he said that they have contracts in place with the Chilean government until 2043, and they feel confident the government will honor these contracts up until that point, and then thereafter start reworking some of them. So, Nick, how do you think this is going to affect Albemarle specifically in the coming years?
Yeah, so as far as Chile's intent to nationalize its lithium industry, this is something they did years ago, decades ago, I should say, with their copper industry, and it didn't go so well. Basically, this is not a done deal yet. Chile's Congress still needs to pass this. That's expected to, happen one way or the other by the end of this year. So it's not a done deal yet. And even if it does go through, yes, it sounds like Chile is going to create a new state-controlled entity, basically a state-controlled company that plays in the lithium market. That could put a damper on lithium prices coming out of Chile. We don't know how that could work yet, so this is a wait and see. But we like Albemarle's position here. Again, not just because they're globally diversified, but specifically because they have operations in the United States, in Australia, jurisdictions that are, of course, very heavily regulated, especially from an environmental perspective. But I think that actually could benefit Albemarle because they have their foot in the door already in those markets that are tough to enter. And then once you do enter them, I think the US and Australia are obviously very interested in keeping these industries stable going forward. Western Australia in particular, Australia's economy really built on natural resources. So we like Albemarle's position here. They're not so highly reliant on lithium coming out of Chile. So Kasey, I know you've been doing some research on this. I wanted to ask you about some of this controversy, I guess, about water usage in the lithium mining process, specifically direct extraction versus this evaporation process. Albemarle is working on direct extraction. What have you learned about that?
Yeah, it sounds like both companies are working on direct extraction, which is a little different than what they're currently doing. What SQM is currently doing is they're pulling brine, non-drinkable water, brine, from aquifers underneath these salars or salt flats. And so they pull up that brine and then lay it out flat, and the sun evaporates the water and leaves some of the salts, the minerals and salts, which is where they're getting the lithium from. And as you mentioned, Albemarle also uses this method in Chile, but both companies are working on this direct extraction. And so the reason direct lithium extraction would be more sustainable for the environment is there's no need for this evaporation. There's no depletion of the aquifer, and which will decrease the harm on the local environment. So just a side point, but definitely something to keep an eye on as things move forward. So that's a good segue into SQM. Here's the slide from their fourth quarter 2022 results. I'm putting this up here because they actually don't report for another week. Do you have any specific points you want to talk about?
Yeah, maybe just a little bit of an earnings preview. I do fully expect SQM, or Sociedad Química y Minera, that's what we're referring to here with SQM. I do expect their results to fall a bit more, maybe a bigger adjustment to 2023 outlook than what Albemarle reported, just because SQM has historically tended to be more of a spot price seller of its lithium. So basically, I think their revenue ran up more than Albemarle's did in 2022 as lithium prices like shot through the roof. So I think now the reduction in 2023 could be more dramatic. Again, they historically have focused less on long-term price contracts and more on spot price market prices. So I think that's basically our estimate for next week when SQM reports.
When we were discussing Albemarle, we showed you the global footprint that company has. Here's SQM's global footprint. Chile, Australia, and China are where this company is, but you can see it's a lot smaller in comparison. It has a much smaller presence in this space.
Right, and I think that's a key risk to keep in mind. So a few weeks ago, I actually wrote an article comparing Albemarle with SQM and pointed out this was the primary reason we have gone with Albemarle is SQM is mostly focused in Chile. They are trying to branch out into Western Australia, but further along in that process. So any changes the Chilean government makes to the lithium market could have a much bigger impact on SQM. Now, of course, SQM also has some contracts in place that go out decades into the future. So they could be just fine by the time this is all said and done. But I think there's just higher uncertainty there. The other thing I would point out here is that I wrote about in the article a few weeks ago is the ownership of SQM is pretty messy. Nobody is a complete shareholder of SQM, but about 1/4 of the company is owned by the old former CEO who resigned in 2015 amid some allegations of insider trading and tax evasion and such. And another 1/4 of the business is owned by this very large Chinese lithium conglomerate called Tianqi. Now, both of these parties, the old CEO, Tianqi, have made an agreement that they're not going to try to wrest control of SQM going forward. But I still think it's worth noting because business interests change, business is war, and it's just an added risk in my mind if you have these two other entities that could eventually try to control SQM, and of course SQM selling a lot of the basic lithium in an offtake agreement to refiners in China. It's just not the same end-to-end, well-diversified lithium business that Albemarle is at this point. So I think that's a risk worth bearing in mind.
To go along with your point about the reliance in Chile as well, one Reuters report said that SQM has about 200,000 acres of lithium extraction versus Albemarle's around 39,000 acres in Chile. So as you mentioned, this company is heavily based in Chile. It's a Chilean company. And so that could definitely cause some risks going forward as if the Chilean government decides to tear up some of those contracts that they have through the next few decades. So let's talk a little bit about SQM's dividend payments. I know that has definitely been quite shiny to a lot of investors over the recent months. So is that something to hang your hat on?
Well, it would certainly look like it is. Just a side-by-side comparison, Albemarle just started paying a dividend recently. It yields 0.8% a year. A dividend payment at this point is no reason to invest in Albemarle, unless, of course, you think that dividend payment is going to rise in the coming years. By comparison, SQM's dividend is 15%. Some of that is the reduction in share price, of course, but also I think this is really important, and many investors don't realize this. SQM's dividend is variable. It is not fixed. So 15% is the current trailing 12-month annualized dividend yield. Because SQM's dividend payment is variable based on the company's profitability, I think the dividend payment for 2023 could very likely be smaller than the dividend payment was in 2022. So that's the pitfall of having a variable dividend. You can't just simply expect the 2022 dividend payment will be exactly the same in 2023. With lithium prices falling, specifically lithium carbonate prices falling right now, versus spodumene, which Albemarle has a bit more exposure to, that price has continued to creep up in recent months. SQM more solidly based on lithium carbonate prices, which are down big, which I think means profits will be down a lot, and there's going to be a smaller dividend payment going forward.
So in our versus segment here, we have Albemarle versus SQM. Let's talk about valuation of these companies, what's a fair value, and if you're a buyer.
Mining stocks are a whole nother animal. They are highly profitable, but they are also highly volatile because they are so tied to base material prices on the market. So I think trying to do a fair value estimate, especially one over the long term, is absolute folly for a mining stock. And that's always reflected in the valuation. You tend to see mining stocks with a single-digit earnings per share multiple. And that's the case now with both of these companies. Albemarle trading for about 7-8 times expected earnings for 2023. SQM, of course, as we record this, we're still awaiting their first quarter update, but I think they're going to probably roughly come out somewhere in the same 7 to 8 times 2023 earnings. That's kind of my estimate, but that can change very quickly based on lithium prices, which have been highly volatile this year. So I think more so than most stocks, timing your purchases of these is crucial, which is why I think we're going with Albemarle. It's very much still in growth mode. And I think we have maybe a slightly more visibility into growth, at least from a volume of lithium sold standpoint over the next decade. So we like the 7-8 times earnings multiple going forward. Of course, we don't get much of a dividend currently, but I think that's just because Albemarle is not as far along in its dividend paying journey as SQM is. So I think this is going to be a dividend growth story as well over time. We like the diversification across multiple markets, not just in Chile, but also the US, and most importantly, Western Australia, which is what will continue to be the dominant producer of raw lithium going forward. So similar multiples, earnings multiples. And so I think given some of the extra risk factors with SQM, that's why we're leaning towards Albemarle.
Okay, time for our bonus round. This is almost like a mini versus segment. We're going to talk about On Semiconductor versus STMicro and Wolfspeed. So Nick had a really interesting conversation recently with On Semiconductor CFO Thad Trent. So Nick, can you tell us what interesting things you guys had to talk about?
So I sort of segmented the conversation into 3 main points. Of course, all the rage right now is silicon carbide, the new chip substrate. that is helping power electric vehicles, renewable energy, and all sorts of like high voltage applications in the chip market. So the three segmentations, On Semi is emerging as maybe not, if not the top silicon carbide chip producer, one of the top silicon carbide producers. Second, they're doing so highly profitably, which is, of course, a very important factor if you're looking for an investment in a new growth theme like this. And then the third, an outlook for how any weakness in the automotive market could impact On Semi. So those are kind of the three takeaways I got, the three primary takeaways I got from this conversation. And so hopefully that breaks up some of my ramblings here. On that first point, it's interesting, over the last few years, Wolfspeed, which was formerly Cree, and they kind of offloaded their lighting business to focus on silicon carbide, really have done a fantastic job marketing themselves as the silicon carbide pure play. They have been building a couple of brand new fabs in the US to kind of position themselves as that, but they're only just now approaching $1 billion in sales. And they're losing money doing it because, again, these fabs are new and they're not operating anywhere close to full capacity, which means they lose money. Keeping those lines running loses money. It burns through cash. They need funding from the CHIPS Act. They need outside investor funding to keep things going. But even by the end of next fiscal year, with an annual revenue run rate of over $1 billion, they're only going to be operating at roughly 20% capacity, which means this company is still going to be losing money for at least a year, if not more. Meanwhile, On Semi expects to get about $1 billion in revenue from silicon carbide this year. Impressive, especially for a company that just surpassed $8 billion in annual sales. So roughly, let's say 15% of their revenue at On Semi will be silicon carbide. Compare that to STMicro. They actually think they'll do about 1.2 billion in silicon carbide revenue this year. However, they're double the size of On Semi. This is a $17 billion a year revenue company. So On Semi, their 1 billion from silicon carbide means much more of their revenue is sort of over-indexed, you could say, to use a phrase that Thad Trent used. They are really over-indexed to silicon carbide and the EV market. So if you're looking for a top bet on silicon carbide, On Semi actually kind of semi-quietly emerging as a top player in this space. The second point, they're doing so profitably. So Thad Trent mentioned a couple of times an acquisition they made in 2021 called GTAT, or GT Advanced Technologies. Basically, they got some tech from this acquisition that allows them to build their own equipment for making silicon carbide bowls. Now, those bowls are basically the big giant, you could say like you like to think of it, Kasey, as like a log of salami made out of silicon carbide. Those bowls get made, and then that salami bowl is what gets chopped up into the wafers, the discs, the silicon carbide discs that we always see in pictures, someone in a bunny suit holding in a lab. And those eventually get chopped up into chips. On Semi is building an end-to-end supply chain, internal supply chain, to build, not just the fabrication of the wafers, but also the actual bowls that no one ever really talks about. They're doing that in-house, then they're chopping them up into wafers, and then they actually make the chips too. So by the end of 2023, Thad Trent said most of, not all, but the majority of their silicon carbide boules will actually be produced in-house. Also, because they're not building brand new fabs, they're actually taking existing fabs they already have and slowly migrating those manufacturing lines from silicon to silicon carbide. They're also able to do this profitably. So they're actually running closer to full capacity versus Wolfspeed, which is not anywhere close to full capacity, not even half capacity, not even a quarter capacity. So onsemi actually able to make this transition to silicon carbide profitably and scale up their operations in accordance with what their customers need, which is another important point because there's all this talk about silicon carbide being too expensive. And that's not exactly the truth. It's just simply that we're still early on in this new chip substrate. So eventually silicon carbide prices will go down as production ramps up. So onsemi able to produce what its customers need and scale up as that demand goes up too.
Nick, I'll just pause you there for just 1 second before you move on to the third point. I'm just as you're talking about this, I'm looking over Wolfspeed's most recent investor presentation, and it claims that Wolfspeed is the leading pure play vertically integrated silicon carbide company. So I don't understand. Is it or isn't it?
I think the word pure play is key in that statement. Wolfspeed is going all in on silicon carbide. They also do some gallium nitride as well, which is a related newer chip substrate, but silicon carbide is where they're making all this investment. And so yes, it is a pure play versus onsemi and STMicro, which derive a minority portion of their revenue from silicon carbide. But a pure play isn't necessarily a good thing at this point, especially considering that those fabs that Wolfspeed are in the process of building are losing them so much money. It's a much, much longer term transition for them because they're building greenfield. You know, they're acquiring land and building brand new fabs and now having to get them ramped up to production. It's a multi-year process. And so they command a very high price to sales multiple on this assumption that, you know, this was going to be a much easier project than what it has ended up being. So yes, it is a pure play, but I don't think that's a good thing. I think it's perfectly acceptable that onsemi is ramping up their silicon carbide from an existing fab base and able to do so profitably.
Thanks for that explanation. That helps me understand this a little bit better. And this really leads us to a question that we've been getting a lot. What happens if the automotive market drops out on us? Like, there's all this impetus to investing in EVs. What happens if that market bottoms out?
This is what's kept us on the sidelines with chip fabs in general, right? Especially automotive chips. And also related to that, what if the automotive market doesn't fall out this year, but suddenly we get this surge of supply hits the market, and then just like what happened to smartphones, we suddenly go from undersupply of chips to oversupply of automotive chips later this year. So Mr. Trent admitted this is a situation they are keeping a close eye on. They do not want to oversupply the automotive market because they're basically all in on this, approaching 80%. onsemi is approaching 80% revenue from automotive and industrial markets. So they're closely monitoring supply, and it's a risk. It's a risk. As for the automotive market specifically hitting the skids, maybe consumers are stretched to the max. They stop buying new cars this year. Interesting little stat that Mr. Trent showed me. Even if the automotive market overall goes in decline, EV sales are likely to still continue increasing because we're still working again from a small base. And this is an important point. Even if overall auto sales fall, if EV sales keep going up, this is a win for a company like onsemi because in internal combustion engine powertrain, Mr. Trent said On Semi can sell about $50 worth of content to the automaker. $50 per vehicle. For an EV, and instead of an internal combustion, an EV or a hybrid, it's as much as $1,700 worth of content per vehicle. $50 to $1,700 per vehicle. Even if the automotive market overall declines, it's going to be the internal combustion engine vehicles that take it on the chin, not the EV portion of that market. So really, On Semi's biggest problem isn't necessarily macroeconomics. Of course, that is a risk, and in particular, oversupply of chips. But by and large, On Semi and its peers' biggest issue is ramping up production of these chips to meet surging demand, long-term demand, because that is a massive gain in content per vehicle sold in the years ahead. So basically, point number 3 in conclusion, not just silicon carbide, but really the automotive market and industrial market overall, hitting a new patch of secular growth tailwind here for the next, let's say, 5 years. So we finally bit the bullet. We got some On Semi stock at under $80 a share, and we'll look at adding to the position going forward. And especially if we do hit a situation where there's oversupply of automotive chips and maybe On Semi stock gets hit really hard, we'll be a buyer at that point if there's a cyclical downtrend for the business.
Okay, that's a wrap here in this final segment. On Semiconductor is our pick in this automotive space. So thanks for watching this entire segment of Chip Stock Investor, our marathon show here. We hope you enjoyed this format. Once again, let us know what you think about it in the comments below. So as you may have noticed, we've started using Main Street data for our data visualizations and analysis. Check it out. We'll leave the link below. If you like it and you feel like it would be useful to you to use in your analysis of stocks and companies, the link below will get you 10% off on a premium subscription.
So later this week, we are still doing our post-earnings takes. We're going to do one more shorter versus segment, and we're going to take a look at Microchip and Lattice Semiconductor, both of which had pretty solid reports, but both stocks are down. So stay tuned for that. Look forward to seeing you all there. And we still drink lots of coffee here. That's what ultimately fuels our research and the making of these videos. Link below if you'd like to leave us a coffee tip. Thanks, everyone.